Everyone, the NSCC SFT service is back on the table. And now we have the FICC involved, so check this shit out. So, move certain DRC items, mark-to-market items, cash obligation items, and accrued principal and interest from the required fund deposit. Calculation to cash settlement, revise certain thresholds and parameters in the intraday mark-to-market charge, establish a new intraday VAR charge, and make other clarifications. This one is long. Actually, not that bad. But as far as the SFT service, it's back. So we have NSCC 2022-003, which is the filing, and then we have the advance notice, which is 801. I don't know yet if anything's changed. It's a 396-page document, but as I wanted to go over a couple of reminders. Let me mute my Discord real quick so you don't get bugged with that. So as far as cash collateral, and for those of you who don't know, SFTs involve the owner of securities, typically registered investment companies, pension plans, sovereign wealth funds, or other institutional firms. Now, think back to this. Typically, a registered investment company, pension plan, sovereign wealth fund, or institutional firm. You know, the ones in the repo market. Transferring those securities temporarily to a borrower, typically a hedge fund. SFTs are often facilitated and intermediated by broker-dealers and agent lenders like Fidelity. In return for the lent securities, the borrower transfers collateral, and a net rate payment is typically transferred to either the lender or borrower that reflects the liquidity of the lent securities, as well as interest on any cash collateral. And then cash collateral is marked with the number 2, and it says that the rate payment is typically calculated in a manner similar to interest on the principal balance of a loan and accrues on a daily basis. As a result, the rate payment is typically calculated as a product of a specified balance, typically the amount of cash collateral, unless the collateral consists of securities, and its specified rate, reflecting both the liquidity of the securities and the ability of the lender to reuse the cash collateral. Reuse the cash collateral, divided by a 360 or similar day count fraction. Now, as far as cash collateral, I believe, if I remember right, consistent with the cash market transactions NSCC clears today, where cash is used to satisfy members' purchase obligations and eligible securities, cash would likewise be the only eligible form of collateral for novated SFTs under the proposed clearing service. More specifically, NSCC would limit the SFTs that it is willing to novate to SFTs that have SFT cash, as defined below and in the proposed change, equal to or greater than 100% market value of the lent securities, and would not novate any obligations to return collateral consisting of securities. Supernote 2, see Section 5A of Proposed Rule 56 and the definition of securities financing transaction. So this is where we take this, we go here, and we type 5A, and we go look for this. So right here, Proposed Rule 56, Section 5, Novation of Securities Financing Transactions. So Section 5A of Proposed Rule 56 would provide the NSCC to only novate an SFT if, at the time of novation, the final settlement of such transaction is scheduled to occur 1 business day following the initial settlement, and the SFT cash is no less than 100% of the contract price of the SFT. So, what does this all mean? Let's go to the repo chart. So, the repo chart, if we go here, this is the securities financing market right here. Secured financing market participants right here, this picture here. So the agent lender right here, Fidelity, you got your security dealers here, cash lenders, money market funds, GSEs, bank portfolios, municipalities, central banks, insurance companies, securities lenders, pension funds, sovereign wealth funds, mutual funds, insurance companies, and exchange traded funds. Those are the ones that are lending out securities. So if we go back, we just saw that, again, the non-cash collateral, that it's the securities right now, it's immobilized, right? If you look at these arrows, it's the only thing in this diagram that's immobilized. They've been holding it for something. And my assumption is the SFT service, because, again, when they have to, unwind this whole thing, all the cash you see sitting in there is going to be used to pay back the lending fees, because they have to, as we just saw in the filing. Now again, to give you a little reminder of what this SFT is going to do, or what it's designed to do, it's basically going to be the other end of this repo demand that we see at historic, and when I say historic, it's an understatement, historic levels, like nothing even close. Let me bring up the chart actually. So again, this is what we're talking about here. Let's go back all the way as far back as we can. Nothing even comes close. So the SFT, let's go back there now. It has two major areas of concern. Fire sale risk mitigation being one of them. In addition to creating capital efficiency opportunities for market participants, NSCC believes that broadening the scope of central clearing at NSCC to SFTs would also reduce the potential for market disruption from fire sales. In the case of securities lending transactions, the primary risk of fire sale relates to the reinvestment of cash collateral by institutional firms that are the lenders in securities lending transactions. So they're reinvesting cash into the lenders. That creates fire sale risk. Now, fire sale risk, what that is, it's basically rapid sales of assets in large amounts that temporarily depress market prices of such assets and create financial instability. So they're trying to prevent that. There's a second thing that they're very concerned about. This is liquidity drain risk mitigation. Now, liquidity risk may also arise if, in the context of a stressed market scenario, borrowers or lenders concerned about their counterparty's credit worthiness seek to unwind their securities lending transactions and obtain the return of their cash collateral or securities. This occurred to a certain extent in 2008 when borrowers began demanding to return borrowed securities in exchange for the cash collateral the borrowers had posted to an institutional firm lenders. These runs may require institutional firm lenders to quickly sell off securities that are the subject of their cash reinvestments to raise cash to return to the borrowers, thereby also creating potential fire sale conditions with respect to the reinvestment securities, as described above. Similarly, borrowers may need to purchase or reborrow securities in stressed market conditions, leading to potentially significant losses. NSCC believes that having SFT be centrally cleared by NSCC would lower the risk of a liquidity drain in a stress scenario. Specifically, NSCC believes that having it clear SFT activity would provide confidence to borrowers and lenders that they will receive back their cash or securities and thereby lessen parties' inclination to rush to unwind their transactions in a stressed market scenario. Now, who's clearing this shit right now? The Fed. Now, why are they waiting for the NSCC SFT to become true before they start unwinding? Because they need another Fed clearing in place. If we go back to this diagram and we take a look, this one right here, the Federal Reserve repo window is right here. This is going to be replaced by NSCC. These people here want to know, or want to be sure, that they're going to be able to get their securities or their cash back, and in this case over here, they want to get their securities back in the event of a stressful scenario, and the best way to do that is to put a SRO or the Fed at the desk to basically ensure those transactions will be as agreed upon by the terms. So basically, SFT, in a nutshell, I put red reserve, not Fed reserve. SFT, man, come on. SFT service, Federal Reserve, New York. Show it to me. I know it's the image is in here somewhere. It's a really good image. There we go. So, SFT service. This is the Fed Reserve, the website. So, okay, right here. Remember when I did the Title 12 CFR changes back in July 4th of last year when they came out with the Title 12? They added a bunch of new definitions, encumbered, unencumbered assets. This is why. So there was also another thing that happened. It's the net stable funding ratio, which is what that was about. That Title 12 change was to enable the net stable funding ratio, which has two main components, ASR factor and RSF factor. I've made a whole playlist on this if you'd like to go look at those. But basically the SFT if you look at this legend here, the yellow circle says other funding liability, i.e. unsecured debt or equity. Unsecured. Green is the asset position. And then the blue is the secured funding transaction. So non-rehypothecated equals unencumbered. If an asset is rehypothecated, it's considered encumbered. Encumbered meaning it's weighted down by someone else's lent. So basically, look at where the asset's at on this side. SFTs are non-rehypothecated here, but they're rehypothecated here with the assets. You see how the asset here is non-rehypothecated? The asset actually becomes the liability when it's rehypothecated. That's why everything is effing backwards in the market. When the assets are liabilities, everything's backwards. Rehypothecated means lent more than once. So these asset positions here have been lent more than once, making them encumbered. This SFT transaction is encumbered. Not good for an NSFR. So, unencumbered is what you want. Non-rehypothecated SFT with other funding liability and an unencumbered asset. So, unencumbered versus encumbered. Two major terms that are important. So, anyways, this is back on the table. This is incoming and outgoing collateral volumes. It's been pretty consistent throughout the last, of course, they only go up to May or September 2018, because after that it probably skyrockets. This is rehypothecated outgoing collateral, the straight red line here, or solid red line. Then you have encumbered incoming SFT, which is typically remained lower. And then you got outgoing collateral and incoming collateral. So that's basically that. And there's more things here you can look at as far as charts and whatnot. You got collateral swaps down here, and they only go to 2018, which I think is funny. But anyways, important stuff to read. This shit's gonna be everything. Now let me just look and see in the filing itself when we may see some form of approval on this, because they just withdrew this and then they added it back again. So look at all this stuff to read, man. Oh, it's redacted. Okay, it's redacted now. They've redacted it now. I see. Okay. Buckle the fuck up, everybody. If you remember, buckle the fuck up. It's coming. It's coming. It's coming. Golly. It's gonna be a badass couple of next months.